Today, we will talk about contingent asset, overview and consideration. A contingent asset is a potential economic benefit that is dependent on some future event largely out of a company's control. When these gains will materialize or their precise economic value cannot be determined, they cannot be recorded on the balance sheet. However, they can be reported in the accompanying footnotes of financial statements under certain conditions. A contingent asset becomes a realized asset that can be recorded on the balance sheet when the realization of cash flows associated with it becomes relatively certain. This may occur due to unknown economic value or uncertainty relating to the outcome of an event in which an asset may be created. There are also contingent or potential liabilities, which refer to potential losses that may be incurred depending on how a certain future event unfolds. For example, a company involved in a lawsuit that expects to receive compensation has a contingent asset because the outcome of the case is not yet known and the dollar amount is yet to be determined. Another example is when a company expects to receive money through the use of a warranty, benefits from an estate or other court settlement, or from anticipated mergers and acquisitions. Both generally accepted accounting principles and International Financial Reporting Standards, IFRS, require companies to disclose contingent assets if there is a decent possibility that these potential gains will eventually be realized. International Accounting Standard 37, IAS 37, applicable to IFRS, states that contingent assets are not recognized but are disclosed when it is more likely than not that an inflow of benefits will occur. Contingent asset accounting policies for GAAP are mainly outlined in the Financial Accounting Standards Board's, FASB, Accounting Standards Codification, ASC, Topic 450. Companies must continually reevaluate the potential asset, and when a contingent asset becomes likely, firms must report it in financial statements by estimating the income to be collected. Contingent assets are ruled under the conservatism principle, meaning no gain may be recorded from a contingent asset until it actually occurs. Here are 3 key takeaways. 1. A contingent asset is only valuable if certain events or conditions that are independent of a company's own actions come to pass in the future. 2. Upon meeting certain conditions, contingent assets are reported in the accompanying notes of financial statements. 3. A contingent asset can be recorded on a firm's balance sheet only when the realization of cash flows associated with it becomes relatively certain. Hope this would help. Thanks for watching.